Hello viewers. Now, one of the keys to successful trading is through trade management. There are many variables to successful trading, but one of the key ingredients is trade management. And there's a great process called trailing stops. Now, you may or may not have heard of them, but in this video I'm going to look at 9 great ways, 9 methods that you could utilize to improve your returns. And in particular, as you know, and if you're familiar with my channel, I specialize in the Renko charts. I'm going to apply them to the world of Renko, combine those 9, like I said, with the Renko charts to give you a roadmap to utilize in your own trading. Now, these are ideas and examples. I do suggest that you backtest them thoroughly before going live, and the real key to success here is being as consistent as possible. But before we get into those 9, for those that don't know, I'm going to briefly take you through what a trailing stop actually is. So what exactly is a trailing stop? Well, let's presume you're in a trade. A lot of traders have a fixed profit target set in their trading plan or in their heads. That's going to get them out of a trade. In this example, using trading stops, we don't close it out at that point. We trail it. So how do we do that? Well, when a trader takes their profit and close out their trade, for example, one of the frustrations can be that you keep watching those charts and the price shoots off even further ahead. You might have maybe a percentage target, 1.5% might be your aim, risk reward 1 to 1.5%, and you see it go to a possible of 3 to 1 or 4 to 1, 5 to 1. Very frustrating. So how can you get around with it, around this problem? Well, the answer is trailing stops. It's hard psychologically to deploy, and I would say hard to be consistent with, but if you can get it right, it is a really effective tool. And how are we going to do it? We're going to use technical analysis tools to create that discipline and consistency and add that into our trade management plan. Now we're going to look at a hypothetical gold example. Now, say, I don't know, the price was at 1,000, somewhere around there, maybe 1,100, and we were targeting 1,500 as our fixed target. Remember, we're ignoring the fixed zone. We're going to trail that stop up. Now, for this example, imagine that the horizontal lines we're going to use are Fibonacci lines, and we're going to move our stop just below these levels. As the price makes its way further and further up, we're going to get taken out, and as you'll see in this example, it's $1,700 for $200 extra profit. And also, trailing stops come in many different shapes and sizes in terms of methodology and tools, and we're going to, like I say, take you through 9 of them. But like it says there, the key tip is to be consistent. So let's have a look at that gold example in a sort of chart based, crudely drawn version. So here's that gold example. Now note, this is very hypothetical. I've just hand drawn this just to illustrate the purpose of trailing stops. Now you can see, for whatever analysis we've done, that we're going to put our original initial stop just under that 900 mark, and we're going to get into the trade at 1,100. Remember, we said about that $1,500 fixed target. Well, that's the old method. We're looking at trailing stops for a new approach. So our trade does go in our favor, and as it gets to that 1,500 mark, we're thinking previously we'd close out. No, we're not. We're going to let it go on through that. But what we're going to do, we're going to take that initial stop under the 900 up to the 1,100, so we're breaking even. So we've locked in 0 at the moment, and we're going to let that price move on up. Now, there are ways of further being more scientific, tweaking that further, so you could lock in some profit, but remember, this is just a real basic example just to show you how it works. Then the price goes on up, hits 1,600, which was our next up target. Again, we don't close out, we pull the stop that's now at 1100 to 1500, so we've locked in 400. The price still goes up through the 1600, we're letting it still continue, does pull back, doesn't break back through that 1600 line, and then bursts on up to the 1700 mark. And we then trail the stop from the 1500 to the 1600 area, so we've now locked in $500 of profit. And again, the price goes up through the 1700. We've pulled our stop up to, around about, just under that 1700 area. The price then has had enough. It comes on back down through the 1700 and closes us out. What have we done? Well, we've made a $600 profit on the trade, whereas we would have made $400 if we'd have closed out the 1500. So that's the principle of trailing stops in its real basic form. Now we can do it many ways using many tools, and that is what we're going to get into right now. So approach number one is a brick size trailing stop, and what we're going to do, we're going to set the trailing stop a distance as a multiple of the brick size. Now how we're going to do that in practice? Well, we've got an example here. Euro US dollar, it's set to a 10 pip block size, and we're going to set a trailing stop of 2 bricks. So the trailing stop distance would be 20 pips, and as the price moves favorably, the stop loss would trail behind, maintaining a distance of 20 pips from the highest high for long positions or the lowest low for short positions. And if we just take a quick example, let's have a look here. Let's presume around this sort of zone here, we decided to go short through this breakout down here. Maybe our initial stop was in here, and as soon as the price starts moving by block down there, we are 2 blocks behind it until obviously the price reverses back out and takes us out. So good for a trend-based following approach, but I would recommend that you back test this sort of style quite thoroughly on the market. So your trading is key to get the right block sizes here, because as you can see on the chart, it's not always trending. You get these shorter, smaller trends, so we've got to know that we've got an edge there, that we're going to get the points, the pips out of this type of approach. Now it's up to you how many blocks you want to set, how aggressive you want to be, 2, 3, 4. Again, it depends on the trend. Maybe smaller block sizes, you might get more blocks in the trend compared to a bigger block methodologies. But again, test. Again, this is just an example to give you an idea of how to use this approach. So our second approach is called a percentage based trailing stop. We're going to calculate the trailing stop distance as a percentage of the brick size. Now in the example here, we've got Apple, the US stock, using a fixed block size of $1 and a trailing stop of 5%. So that would be equal to 0.05 cents, and as the price moves in our favor of the trade, the trailing stop would be adjusted by 5 cents below the highest high for long positions or above the lowest low for short positions. So again, typical example, we might want to go short at this point as it broke on down. Initial stop might be just above the turn there, but we want to get 5% of the block size there for our move down. And again, in percentage terms, we would take that down 5 cents, as it said in the example, until it reversed on back on through. So it's almost similar to the first approach of the brick size trailing stop, but we've just got a percentage in there of the brick size. In this example, it was $1. So again, recommendation, test out thoroughly. Very important to get the right block size, and I have videos of that on the channel, getting the right block size for different trading styles and approaches, and I'll put a link to that playlist and the videos inside that at the end of this video. Now third up, we've got an ATR based trailing stop. What does ATR stand for? Average true range. Again, hit that playlist. It's got all about this in there if you want to learn more. In this example, crude oil, a bit more work here. I use more these type of approaches. Now on the right, we've got a daily chart here, and we've got the ATR indicator put at the bottom. You can find that just by going up to indicators, typing in average true range and pulling that back. It's the daily one, and every day it's saying it's going to move at the moment crude oil about $2. Now on the left, I'm using, as you can see, a $1 block size there, so each one of those is $1. Now how can we set a trailing stop based on the daily movement? Well, we've got one here there, so we might take this number here. Again, you can be an aggressive and tailor it in as hard as you like, or as far away as you like if you want to be more conservative. $2 is about the ATR at the moment, so we might have a, say, a 2 times ATR approach, so that would give us a $4 trailing stop. So we would maybe put the trailing stop under there, and then each block up we move it up one, basically in terms of the $4. That might be too conservative for you. Maybe just 1 times ATR, half times ATR, completely up to you. But again, like all of these methods, please do the back testing. You practice on this first before going live with any hard-earned cash. So number 4 on our list is using a moving average trailing stop. So we're going to add on our moving average. Again, you can type it in. I've got them on my short list here. Just a simple one, sufficient. Let's color it in, make it a bit more obvious for this video. Let's make it bigger and more colorful. There we go. Let's set it to 10, for example. Now, what I really like about the Renko charts is they do define the trend very nicely and show you more clearly when to get in and out. And this is the example with this approach, very effective. So let's say, for example, we saw this double bottom here and we wanted to get in. Remember, it's hypothetical. There, we broke in there, our initial stops there. And what we're going to do is we're going to, maybe you give it some time to start working first. You can define that period, or you can go straight in, because you can see the 10 period moving average is very close at the moment. So you might say, well, I'm going to wait for 2 blocks first and then start trailing it up. But what you're going to do is you're just going to put it all the way behind until we get there, we close out when that block closes through the moving average. And there it closed at about 68,199 and we got in 67,312, so 1,800, nearly 2,000 points of profit on that method. Then we've got one of my favorite approaches, which is the volatility based trailing stop. What are we doing here? Well, we're adjusting the trailing stop based on the volatility of the market. Well, you could be trading options and you could use maybe implied volatility. So if it's high implied volatility, you use a wide trailing stop. Low, conversely, low volatility environment, you might use a tighter trailing stop. How are you going to know those sort of details? What is in terms of implied vol? Well, if you're an options trader, you're probably going to have access to that data anyway. But if you haven't, then another approach using volatility around your trade is through the charts. And on the right hand side, well, we're using Meta, the big US stock here. We've got $2 block size, but on the right we've just got an ordinary candlestick chart. We've got at the bottom here the historical volatility indicator. Now if we go up to the top, there it is. Just type in historical volatility. I'll show what settings I've used. I like to use a 50 period on the daily, and then I've smoothed it out with this 50 period moving average. So it's telling me annually, the Meta vol is about 45%. Now, depending on whether you are day trader, scalper, a longer holder of trades, we adjust this volatility to, say, a daily amount. So maybe it moves 1% per day on the price, or maybe we know that our trades only last an hour, 2 hours, and we get that even tighter. So we take maybe 10-20% of that $1 daily move. Maybe it's just 20 cents. But again, it's the same principle as all the others. We've looked at the example here. We're thinking it's going south, and according to the volatility at the time, we put our stop, that fixed amount. We might have gone in here, and our initial stop's there. Then we move that stop down according to the volatility calculation. So we take the amount we want. Let's just say it's 1%. So we take 1% of the price. So we follow it down, whatever 1% of that price is. Or like I said, you can be more aggressive. It's 10% of 1%, maybe. You're taking 10 cents for your trailing stop. Again, the key to this one is to clearly lay out a defined approach before you start, and stick to that methodology to make sure you give it a fair chance to work. Next up, we're going to use Fibonacci as our trailing stop approach, a more aggressive Fibonacci setup. Now, we've got Amazon here, $1 block size, and you can clearly pick, the lows and the highs here. So you might, more traditionally get your Fibonacci set up, something like that. Let's just color those in so we can see more clearly what that looks like. But Fibonacci is a fantastic tool for trailing stops. Now there are other, if you're intraday, you could use other types of methodology around, different types of bands like these Fibonacci's. But I think Fibonacci can create a really good roadmap for you. Now that would be our typical longer term trade roadmap, but we're traders, we've got to be more aggressive in here. Now let's take out a typical trade example. Let's zoom in a bit here. Let's say for whatever reason we are going to go short as the price breaks on down through this area here, with the expectation of it moving back to maybe this zone and then breaking through again down to the key $158 area, which is that 38.2% Fibonacci line. So a big trade there. Now our getting in point is about here. Maybe we've got a reasonably aggressive stop just above that moving average. So there's our risk to the trade. And how do we introduce Fibonacci? Well, what we're going to use are the Fibonacci we laid out with that longer term there. We're looking for a downside trade. So again, we can take maybe from the high there, and we can create like a sub roadmap within the trade. So we go down to our target maybe there, draw that on, and what we're looking to do is then ladder down the approach. So as the price moves on down, say through that first sort of intra Fibonacci line, we then move our stop to the previous Fibonacci line, and you keep going downwards until, again, like we saw right in that hypothetical example at the start, we get taken out when the price reverts on maybe backwards. And you can be as refined as you want inside that. So it's sort of doing Fibonacci bands within Fibonacci bands. Let's just remove the drawings there so you can see it a bit more clearly again. We're in a short trade, create shorter Fibonacci zones downside. That's, you can even do it this way. just take the high to the low around that trade, depending on your risk appetite, your trading plan, how aggressive you are on the asset that you are trading. And like I said, you've created, again, maybe we're getting in short as it breaks that Fibonacci line. Stop just above there. Like I said, you get through the first one, or maybe you even let it go to the second one, and you bring that stop down from there into here. And you just ladder it down as you keep going, put in the Fibonacci lines that you require, tighten it up, widen it, down to you. Again, caveat, test before you apply. Just one last example on the Fibonacci's. We've got in the video here $7.50 block size. Now we're believing in this trade that the price, after that consolidation that we've seen in here, pull back from those highs, is going to go up further again. We can create a roadmap for ourselves going forward by using the fib retracement here in the setup. Again, we're going to go aggressive there, two lows there. Now we've got our roadmap going upwards, and as the price moves on up, now our initial trade idea might have been to get out around 1,000, but we're going to use this roadmap to take us forwards, stay in that trade longer. Let's pull that down there, and we can see actually from the trade that possibly 1160 is a possible target. And again, we can fill that in as maybe when we get to our initial 1,000 target. Again, we can draw that, and again we can ladder the trailing stop as it goes up through these new zones, again taking out the uncertainty of the trade. So for this example, we're going to use indicators on top of the price action. You can use Bollinger Bands or Donchian Bands, but I like to use an offset in there. What do I mean by that? Well, let's find Bollinger Bands, for example. Let's modify the data there. So let's make it more aggressive, 10-1 standard deviation, but this box here, let's set it to a 5, and let's just tidy that up a bit so we can see more clearly. We just need the upper and lower bands for this example. Let's make them white. There we go. So what's the idea of this type of trade? Well, remember that again, this is just an example. But let's say we wanted to go short as the price came down here. What we do is we trail our stop behind the lower band if it's a short trade, and we close out as it goes up through the band there. Now the more aggressive the trend, obviously the better the results will be. Again, this is an example of how to implement another idea onto your trade, and again vice versa for the long trade. You get out as it breaks on back down through the top band. So that could be your Bollinger Band approach. A Donchian one, well, let's have a quick look at that. I find it a bit more aggressive, a bit well, I like to use it more than the Bollinger Band set. As you can see here, it looks a bit more aggressive, like I said. Again, that same sort of short area. As the price comes down, we trail it behind there and it closes off, we get out there. Again, we can get back in, close out, and keep doing that as your rule set. Again, the trend becoming your friend there, closing out, keeps you in that trade a bit longer. Go down behind that lower band, and the vice versa for the upper band. How did I find the Donchian? Again, just go in there, type in Donchian. I put Donchian offset as my one, and I believe it was this one by Russ43. Then just change the variables. This one, if we click on it, I've had it set up at 3-3, so you can experiment with the numbers. 5-2 gives you a different set. You could be more conservative, maybe 10. I like to use numbers. Don't fit obviously the data to the Donchian numbers. That's going to get you in a lot of trouble. Be consistent across assets. I like to use more faster, say 3-3. You could even go 2-2 if you really wanted to. Again, it's about, does it work for that market, that strategy that you've got. Now methods 8 and 9 I'm going to combine into this one chart here. We've got crude oil, and this one's about support and resistance, price patterns on the blocks. You can use key obvious areas, like we've got one here, treble top there. You might have zones of price support. You bring the price up as it moves on through using these different levels that are obvious and more obvious, which I really like with the Renko charts. Double tops, double bottoms there, for example, you can use as potential areas. You've got treble top there, very good for breakouts as well. But the support and resistance, helping you pick key zones. You could maybe trail behind trend lines, that sort of action. There are so many different ways to use the trailing stop, but the key to this all is to be extremely consistent and deploy it time after time on every trade. If you tinker with it, mess around, try different approaches, you're going to get into a whole heap of mess and your results aren't going to look good. You've got to be, like I say, very methodical, very consistent in the application of this approach. Otherwise it's not going to work. You're going to give back the profits that you have made, mess yourself up. So please test out thoroughly and give it a chance to work. Be consistent, and you should be fine. So there you go, 9 different approaches to trailing your stops using the Renko charts. I particularly like the ATR historical volatility approaches, and those ones with, we saw the indicators, the Bollinger Bands and the Donchian Bands. Really do like those setups, and I apply them to different strategies that I utilize. Again, like I've reiterated throughout the video, please do your own testing on these methodologies and make them as consistent as you possibly can to give them a chance to work. Now, we've gone through a lot in this video. If you've liked it, please give us the thumbs up. Don't forget to hit the subscribe and bell buttons, because I'm always producing content around the Renko chart, stop loss, approaches, risk trade management, a whole host more on the channel. So really appreciate your support, and if you want to learn more, then stay with the channel. And like I said, also got a great playlist on the YouTube channel all about Renko, all about how you get the right block sizes, different indicators, methodologies, a full training course there for you. Work your way from the top to the bottom and you'll be a Renko master by the time you've come out the other side. And that playlist coming up right now.